SCHG's 107% crushed VTI's 84%. But that extra 23 points came from holding just 196 stocks versus VTI's 3,484. Now let's shift gears and look at SCHG's crushing it with 125% versus VTI's 78%. That's a massive 47-point gap showing growth stocks dominated these 3 years. But here's where it gets interesting. SCHG's crushed it with a 107% 5-year return, powered by heavy bets on the biggest tech giants in the market. Let's zoom in on this. VTI's 84% 5-year return shows how broad diversification quietly builds wealth. Solid gains without the wild swings or sleepless nights. In plain English, think race cars here. SCHG finished 23 laps ahead of VTI over 5 years. Same track, different engines. That's what focused growth strategy can do versus broad diversification. Here's where the story takes a turn. SCHG's 125% 3-year return shows what happens when you bet big on mega-cap tech and the market rewards concentration. Let's break this down further. VTI's 78% 3-year return shows how diversification protects you from crashes, but limits your upside when growth stocks soar. VTI's 18% 1-year return shows how broad market exposure lets you capture gains when all sectors rise together. Now for the real question. SCHG's 16% return shows what happens when mega-cap growth stocks lose favor. It's trailing when market leadership shifts away. In plain English, when growth stocks tumbled, it's like dominoes falling. Concentrated funds crashed first, while VTI's broad diversification kept it standing. That's the power of spreading your bets across thousands of stocks. A 1.3 Sharpe ratio means SCHG isn't just winning, it's delivering strong returns without taking crazy risks to get there. Now let's put this in perspective. VTI's 1.1 Sharpe ratio shows solid risk-adjusted returns, though it's trailing behind SCHG's efficiency over the same period. But wait, there's more to this story. SCHG's 1.8 Sortino ratio shows it handles downside risk well. You'll get better protection when markets drop compared to typical funds. Here's the thing though. VTI's 1.5 Sortino ratio shows solid downside protection, but SCHG's focused strategy dodged bad volatility even better here. In plain English, think of this like grading papers. SCHG earned the honor roll by squeezing out more return for every bit of risk it took. VTI passed the class, but SCHG aced the test. Now here's where it gets tricky. SCHG's 20% volatility means you're riding bigger swings. Concentrated bets amplify every market move, both wins and losses. But that's not the whole picture. VTI's 15% volatility means steadier returns. Diversification spreads your risk across thousands of stocks, smoothing out those wild swings. Let's see how this plays out. SCHG's concentrated portfolio means you're riding constant price swings. That 22% volatility isn't going anywhere soon. Here's what really matters. VTI's 17% volatility over 5 years shows how broad market exposure smooths out the ride compared to concentrated bets. In plain English, here's the amplifier knob analogy. SCHG cranks volatility to maximum while VTI keeps things comfortable. Higher volume means bigger thrills on the upside, but also much steeper drops when the music stops. But hold on a second. SCHG's worst 3-year drop hit 23%. That's the price you pay when mega-cap concentration bites back hard. Let's unpack this a bit. VTI's worst 3-year drop, just 19%. That's the power of diversification. Spreading risk means you dodge the worst crashes. Here's the key takeaway. All right, pause and think. Which fund takes the crown? VTI or SCHG? Now let's flip the script. SCHG bounced back in just 83 days. Proof that concentrated bets can recover fast when the market mood finally shifts. But there's a catch. VTI bounced back in just 80 days. Diversified portfolios recovered nearly as fast, but never fell as hard initially. In plain English, here's the staircase truth. SCHG tumbled from a higher step than VTI, but both climbed back at the same pace. The difference? SCHG's initial fall was steeper and more painful. But here's where it gets interesting. When growth stocks tanked, SCHG's concentrated portfolio didn't cushion the fall. It amplified it, crashing 35% over 5 years. But here's where it gets interesting. VTI's worst 5-year stretch saw a 25% drop, but its broad diversification softened the blow by 10 percentage points compared to alternatives. Let's zoom in on this. SCHG bounced back in just 347 days. Those concentrated mega-cap stocks powered through the recovery much faster than most portfolios. VTI took over a year to recover, 433 days. That's the trade-off when you're spread across every slow-moving sector imaginable. In plain English, SCHG is like a rocket blast off here. It burned harder on the way down, sure, but when recovery hit, it absolutely launched. VTI, more of a slow, steady climb back to orbit. Let's break this down further. VTI's 0.03% fee is basically pocket change. You're keeping 99.97% of everything your investment earns each year. Here's where things get revealing. At 0.04% annually, SCHG costs just 1 basis point more than VTI, still incredibly cheap for what you're getting here. Now for the real question. Here's the difference. Just $1 per 10,000 you invest. Expenses won't decide this battle at all. In plain English, the fee gap here is pure couch change. So tiny you wouldn't miss it if it fell out of your pocket. Focus on performance instead. That's what actually moves the needle for your returns. Here's where things get revealing. SCHG's holding just 196 stocks means each position really matters. There's nowhere for underperformers to hide in this concentrated setup. Now let's put this in perspective. VTI spreads your investment across 3,500 companies. No single stock failure can tank your entire portfolio here. But wait, there's more to this story. SCHG's got 62% in mega caps, meaning your returns basically hinge on how the market's biggest giants perform each day. Here's the thing, though. SCHG's delivered a stronger 107% return over 5 years, but you're paying for it with 35% drawdowns and higher volatility. VTI's smoother ride at 84% might help you sleep better at night. Let's take a closer look. VTI's got 40% in mega caps, but spreads the rest across mid and small companies for better diversification. In plain English, SCHG's concentration is risky. 62% in just its top holdings versus VTI's 3,484 holdings spread more evenly. Like the egg basket analogy says, fewer baskets mean one drop hurts way more. But that's not the whole picture. SCHG puts nearly half its money in tech. That's a massive bet on one sector driving your returns. Let's see how this plays out. A third of the portfolio in tech, enough to capture growth without betting the whole farm on one sector. Here's what really matters. SCHG's 11-point tech overweight drives both its stronger returns and higher volatility, compared to VTI's broader market approach. Now, let's connect the dots. SCHG's massive tech exposure and mega-cap focus turned into a 5-year winning formula when growth stocks dominated the market. In plain English, SCHG's tech-heavy concentration created a classic egg basket problem. Massive wins when tech soared, brutal losses when it cracked. VTI's diversification cushioned the fall, but also capped the gains. Let's unpack this a bit. When mega-cap tech stumbles, VTI's broader sector mix delivered 18% versus SCHG's 16%. Diversification's advantage revealed. Here's the key takeaway. Concentrated bets on winning sectors and stocks can deliver 23 percentage points more over 5 years if you pick right. Now let's flip the script. Concentration cuts both ways. It fuels those incredible gains. But when the market turns, you'll crash 10 points harder than diversified funds. But there's a catch. That 22% volatility means constant emotional testing. Wild swings that'll shake your confidence while VTI investors sleep soundly at night. In plain English, here's the classic risk-reward seesaw. SCHG swings higher during rallies, but crashes harder when things go south. VTI, it's your steady middle ground player, balancing both extremes. Now let's shift gears and look at SCHG. Absolutely crushed VTI by 23 points over 5 years, when mega-cap growth stocks dominated the market completely. But here's where it gets interesting. VTI's lower volatility at 15% versus SCHG's 20% means smoother rides and smaller crashes. 25% drops versus 35% over 5 years. Let's zoom in on this. SCHG's 1.3 Sharpe ratio beats VTI's 1.1, delivering more return per unit of risk. And it wins on downside protection too. Let's dig into the details. VTI holds over 3,400 stocks. That's serious diversification. No single company meltdown or sector crash can wreck your entire investment. In plain English, SCHG's like the thrill seeker on the seesaw, launching higher with bigger gains, but crashing harder when gravity kicks in. VTI, the steady one who keeps balance, never flying too high or face-planting too hard. Let's break this down further. SCHG dominates when tech giants run the show. VTI wins when the market spreads the wealth across different sectors and sizes. Now let's put this in perspective. VTI's 18% crushes SCHG's 16%. Proof that broad diversification's beating concentrated growth bets in today's market. Now for the real question. SCHG bounced back faster by 86 days, but that deeper 10-point crash meant investors suffered longer overall. Let's dig into the details. SCHG's 196 holdings mean one stock crash hurts more, while VTI's 3,484 holdings spread the risk across way more companies. In plain English, SCHG's got just 196 holdings. When one stumbles, you'll feel it. VTI spreads across 3,484 stocks, so individual shocks barely register. It's the classic dominoes falling problem of concentration versus diversification. Now let's put this in perspective. SCHG's got 62% riding on mega caps, so when they soar, you're golden. But when they tank, you're taking serious hits. But wait, there's more to this story. SCHG's 44% tech allocation makes it vulnerable during sector rotation, while VTI's 33% offers more cushion. Here's the thing though, SCHG's 107% 5-year return shows how perfectly timing mega-cap growth stocks can deliver absolutely explosive long-term gains for investors. However, Nobody can predict which style will dominate next. Growth funds and broad markets take turns winning based on market conditions. In plain English, here's the weather forecast for your portfolio. SCHG thrives when markets are calm and sunny, while VTI is built to weather any storm. Choose your fund based on the market conditions you're expecting. So there's the choice. Chase mega-cap growth's upside with SCHG's volatility, or get VTI's smoother, diversified market exposure instead. Let's see how this plays out. So, which fund's right for you? SCHG, if you're chasing maximum growth with high risk, VTI for steady diversified returns. In plain English, here's the sports car analogy. SCHG's built for speed and excitement, but you'll need nerves of steel for those sharp turns. VTI? It's your steady cruiser that won't leave you stranded. Now let's connect the dots. Standard disclaimer here. Do your homework, consult professionals, and invest at your own risk. But hold on a second. That's a wrap on our ETF battle. Hit subscribe if you want more weekly breakdowns comparing funds head-to-head like this.